Hey everyone, welcome back to a new video in our Nifty50 series. And today we are covering Tech Mahindra Limited. It's the first IT services company that we are covering in our series. So we'll start off with some industry analysis of the IT services company of the industry. If you look at the value chain, this is where the Indian IT service vendors come into the picture. They're basically supplying to your enterprise technology buyers, right? So these are the clients for which our Indian IT services companies are building solutions for. And these can be like big players in the banking sector, in the telecom sector. Usually the tech budget of these companies is around 3 to 6% in the industrial or telecom space, or around 10 to 15% in the BFSI space. So you can see BFSI companies have a larger budget uh, um, for the tech services that they want to buy. Buyers are usually concentrated in the US. So for Indian companies, almost 50%, half of their revenues is coming from the US, and there are also some European clients. So then are your Indian IT service companies. These are your TCS is the big player, 24 to 25, 1/4 of the revenue share. Infosys is there, HCL Tech is there. Tech Mahindra is taking like 10% of the market share here. And they're basically building applications or they're managing their infrastructure, even now providing AI solutions to solve certain problems for these big buyers. And then there are your technology platforms. These are the hyperscalers or the enterprise software companies, which are actually providing the platforms on which these vendors are building solutions, right? Now, one interesting thing is if you look at the gross margins of these platform companies, this is like 60 to 80%, whereas the EBITDA margins for the Indian IT services are at 10 to 25%, right? So you can see where the profitability lies in the value chain, right? If today you are to enter this value chain, you can make a wise decision and choose one of these layers to jump into, right? Just bases the profitability. There are other factors as well. And then the fourth layer is like specialist subcontractor staffing agencies, for example. Subcontractors would be like, even TCS is like having sub vendors for certain niche applications. So this would be the lower layer, and this is the margins run 3 to 8% here. So it's not very interesting, right? In terms of types of players, I will discuss one categorization, which is by scale, right? You have the mega cap companies such as your TCS and your Infosys. These are the big IT companies. They have almost $15 billion revenue per year. Then are your large caps, then there are mid-tier companies, then there are specialists. So large cap is where Tech Mahindra would lie, okay? Mid-tier would be again some niche vertical or some service line focus. And specialist would be like very niche vertical or even more niche services such as Tata Elxsi, which is into engineering R&D. Right? So this is how you can categorize the different players in this industry, or one of the ways of doing that. In terms of industry regulations, I'll discuss one regulation which happened 2 years ago, where the H-1B visa fee was increased. Not only was the filing fees increased materially, the approval scrutiny for IT services was also tightened a lot. So this was kind of a cost impact which the IT services companies had to absorb. The Trump administration is posturing even further restrictions, right? So this is a negative for the industry in general, right? I'm going to skip tailwinds and headwinds, and we're going to dive into some subsector analysis next. So, all right, we have identified two subsectors to dive a little bit deeper into. And these two subsectors are the telecom ID services. So ID services specifically provided to the telecom sectors. And then there's the more broader ID services, which are provided across industries in the BFSI, manufacturing. This is more the general use case of ID services. Why we are diving deep into telecom ID services as a subsector is because for Tech Mahindra specifically, 33% of their revenues is coming from this end user industry. And this is where they have kind of they are distinct from other general ID services companies. I mean, this is where the company's historical deepest vertical specialization has been. Tech Mahindra was formed as a merger between Mahindra and British Telecom. So it has deep roots in the telecom industry. Um, and then, yeah, so this is the two sectors. We're quickly going to glance over what's happening in terms of the supply side. If you see the market share, firstly, if you see the market share, Accenture is the globally the bigger player in the telecom services, and then TCS also is a bigger player than Tech Mahindra. TCS is the biggest player in the Indian ID services as well, right? So Tech Mahindra is number three, number four player in both these subsectors, okay? Now, what's happened in the telecom ID services is that it's been in a cyclical trough since FY23, where basically the discretionary ID spend was cut after while the 5G investment peaked, right? So from the end user itself was not willing to spend a lot of money. So what has happened is the industry or the subsector has gone through a tough time in the last couple of years. And we can see that even for Tech Mahindra, communications vertical revenues have declined 4 to 5% in the last 2 financial years, right? But now we are seeing some signs of stabilization, right? And this story is also mirrored in the general IT services, but it's slightly different. What happened in the general ID services was post-COVID, there was a boom there was a mass boom in ID services sector where the companies hired, there was wage inflation. And then what happened in FY24, the end users were like, okay, we need to cut our discretionary ID spends. This is getting too much. So then again, a similar story played out where the industry had to, kind of again, the headcount discipline had to be brought in, the wage inflation discipline had to be brought in. Other than that, another thing which has happened is the GCC internalization introduces a permanent structural cap. So now another thing in the supply side which has happened is instead of these big companies giving their money to ID services, they can just set up a GCC, and that GCC, their own GCC in India, which will solve and do the work for them. So that can be a more cost-effective a way that's a threat to the ID services sector in general, right? So that in the supply side has come up. In the demand side, both of these subsectors give us a similar reading, where the demand kind of has gone flat in the last 2 years in terms of the end users. Okay, so that's just kind of understanding the supply demand mechanics which are happening in the subsectors. Okay, now we'll dive a little bit deeper into Tech Mahindra. All right, now moving on to the business of Tech Mahindra itself. If you see the revenue breakdown, 84% of it is coming from IT services and 16% is coming from business process services, right? IT services are more like the good quality work of actual application development or some cloud infrastructure or AI enabled solutions, right? Business processes service is kind of the low quality work of some back office work, some customer experience work, all of these sorts of things. So it's majorly obviously an ID services company, right? And if we see the revenue trend, it's been 8% growth. So it's not been out of the park growth. Although we did see out of the park growth till FY23, double digit growth, but this was obviously the post COVID boom, something which we've been seeing a repeated pattern in the story of this stock, right? That there was the boom in the industry. So whatever the story played out in the industry is also reflecting from the company itself, where in FY24 and FY25, the revenues were pretty much flat, right? Um, so, and even in terms of mix shift, it's kind of remained the same. Nothing has moved up or down. So it's not really a product mix story anyway, right? But yeah, in terms of growth, the growth story of this company is largely correlating with the growth story of what's happened in the industry, right? Now, if we move on to the key variables of this company, what we'll see is something interesting. The new deal wins, you can see it's all in green. Deal momentum has accelerated sharply through FY26, and the LTM figures are at a 5-year high. So what this is pointing towards is this company is suddenly winning good deals. And this is giving good confidence that the revenues are going to inflect in FY27. You know, they are sitting at a 5-year high in their LTM deal, at their LTM figure, right? And they also won a very big deal of, I think, $1.1 billion, a $500 million plus 5-year application modernization contract with a European tier 1 telco, right? So there was a big win in the last quarter. So good signs. EBITDA margins have 9 quarters of successive expansion, right? The target is 15%, so there's still some way to go. But the trough that we saw in FY20 or a couple of years ago is on the rise, you know. So again, a sign that things are improving structurally. Client count has maintained. The company is now focusing on good quality clients. So, you know, the growth is kind of impacted with it, but they've maintained their client counts, especially their big client counts. Attrition rate is 12%, nothing to worry about here. It's not near the peak of 22% when everyone was quitting their jobs, so nothing to worry about here. Their return is also coming back up. You know, it was 28%, the ROCE was in FY22, dipped sharply to 13%. That's not a dip, it fell, broke. But then it's been coming up and it's back to 27%, and the management wants to take it to 30% in FY27, right? So all in all, what we are seeing is what the key indicators are telling us, that in the last couple of years, things are moving in the right direction when it comes to Tech Mahindra. All right, moving on to the growth story for the company. The company scored a 7.8 score on the growth, on the future growth prospects, right? It had a 3-year plan for FY25 to FY27, and it enters a stabilization phase, which is, I think, the third year, the term for the third year, with good deal bookings, right? So we just saw the momentum in their deal wins. They also got a big deal win, which is going to start contributing from next year. So that's going to be a growth catalyst. And then, of course, they launched this, there's a 15% EBITDA margin target, right? They launched this, this kind of project, which was based on operational rigor. The project was basically to increase their efficiency and to improve things, which will eventually lead to the margin goal of 15%, right? So this is sort of an internal, they've kind of given it a name, and this is kind of an internal project which is driving the margin. So that's going to lead to bottom line growth. The deal wins are going to lead to top line growth. And of course, they have an agentic AI platform as well. So if we look at how this is going to play out, the base case would be probably in line with what the management is saying, that we want to grow faster than our peers, right? And this number, I think, if you look at things how they're going, would probably be in the mid single digits, 4 to 6% top line growth, right? In terms of guidance, this is something interesting. The management has a big 3-year roadmap, right? And what they have said is revenue will be greater than the peers. We have an EBITDA margin of 15%. Returns should be 30%, right? So they have some clear targets. And this is something I like in a management where they have long-term goals so that even people like the retail investors can continuously track if things are moving in the right direction or not, right? So this is great, and things are moving in the right direction, especially in terms of margins, especially in terms of return ratios, right? The deal wins are coming through, so the revenue should also reflect the growth soon, right? So credibility-wise, this management has been given a label of high trust. They have delivered 9 consecutive quarters of margin expansion, consistent with their stated operating commitments, right? So what they said, they delivered. In terms of revenue guidance for this year and the past 2 years, there's not much value which you'll get out of here. But in terms of the last 2 years, what we see is either they have beaten their guidance or they have been in line with their guidance, right? So this again ties back into the high trust ranking which has been given to this company. In terms of tracking some items from their con calls, there's the 15% EBITDA margin where we're tracking that, how that's playing out. Project Fortius, right? So this is where they announced their flagship cost saving and operational efficiency program. And what they're saying is this remains the primary engine for the margin expansion. Right, so this is what's actually bringing in the margin 9 quarters of consecutive margin improvement. They also had a capital allocation policy announced where they said 85% free cash flow will be distributed to shareholders. Right, policy was met in FY25 with a payout ratio of 104% of PAT and 122% of free cash flow. So this is good. They are kind of trying to attract or trying to be very shareholder friendly. So again, these are all good signs of a management, right? The guidance tab is kind of an indirect assessment of the management without going too deep into their experience or their pedigree. But have they been doing what they said? Is a good test of a management as well, right? So yeah, that's it. That marks the completion of Tech Mahindra analysis. I hope you liked it. Thank you.